We are everywhere.
Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. The International Monetary Fund downgrades India's 2020 growth forecast to 5.8%, says the India slowdown is the key factor behind trimming the global growth outlook. There are signs of an uptick in the consumer lending business, according to Sanjiv Bajaj of Bajaj Finserv. That's a BloombergQuint exclusive from the World Economic Forum in Davos. The government appoints managing directors and CEOs for Bank of Baroda, Bank of India and Canara Bank to help stabilize their operations. The Income Tax Department detects that many jewelers have made high-value cash transactions or deposits during the demonetization period and have failed to justify them. The Z Entertainment is the only company that will report its third quarter results today. All right, let's take a look at the Asian markets. There aren't any cues from the US markets, of course, because they were shut. Sophie Kamruddin is joining us live from the Bloomberg studios in Hong Kong. Good morning, Sophie. A few cuts seen in the early risers and, of course, looking for direction because the US markets were shut. Good morning.
Good morning. This Tuesday, Asian stocks are halting a three-day gain with U.S. equities under pressure. That risk-off mood intensifying after a muted open as we learn that Japan is to step up the use of quarantine and testing to tackle the new coronavirus that is spreading in China. Now, mainland equities are then snapping a two-day rise while stocks in Singapore and Hong Kong are off more than 1%, and the Nikkei 225 is lower by 0.7%, with tech the biggest drag on the benchmark. And we have the yen hovering around 110 amid this risk-off mood ahead of the BOJ's policy decision, and the offshore yuan testing 688, but it is the Korean won that is leading regional forex lower, and the Kospi losing ground as investors consider the latest trade figures. Korean export growth slowed in the first 20 days of January, but semiconductor shipments, they are headed for the first monthly gain since 2018. Back to you.
Thanks so much for that, Sophie. Now, on to an update from oil, and concerns about supply disruptions in Iraq and Libya that we were speaking about at the start of the week seem to have been offset by the perception of oversupply across the globe. This is evident from the fact that oil prices are little changed even after major supply disruptions. James Thornhill of Bloomberg News has more.
I think it'd be wrong to underestimate the disruption that's been caused in Libya. They usually produce around 1.2 million barrels, and that's been curtailed to roughly around 72,000. So this is a considerable disruption, and it's certainly lending some decent support to the market. But as you just mentioned at the top, the market is well supplied, and we've seen that in US inventories data in recent weeks. Those inventories have been going up. So that will certainly sort of temper any ructions from Libya and also Iraq, which we've seen in the last few days, protests there, which have also halted some production. So, as long as these production disruptions are ongoing, there will be possibly some upside, but counterbalancing that supply picture, and we'll get a clearer picture on supplies later in the week when the US government gives its weekly report.
And James, how does Iran factor into the equation?
Yeah, well, Iran continues to bubble under. Reports overnight of more conflict between Iran and the EU on how they're moving forward with the nuclear talks. It seems that Iran is being increasingly belligerent. In the face of a tougher stance from the US, and there's always potential for that situation to flare up. And I think traders will certainly be aware of that. As we noted, these geopolitical tensions, they can have initial price spikes, but the longer lasting impact is not as great as perhaps what it was in the future, and that's partly a reflection of the supply dynamics that we discussed earlier. But be wrong to underestimate the risks. Clearly it's a very volatile region, and we could continue to be so in the months and potentially even years ahead.
Let's stick with oil for a bit. Jeff Currie, the head of commodities research at Goldman Sachs, says it will need a substantial amount of disruption to push oil prices beyond the $70 per barrel mark and for them to sustain there. He spoke to Bloomberg's Stephen Engel at the Goldman Sachs Global Macro Conference. Listen in.
Let's take a step back and ask why we're bullish on commodities. And the answer for that is we see declining investment across the commodity space. You look at energy, you look at the rig count. The rig count has continued to fall over the course of the last year. You look at metals and mining, investments off sharply. And if you think about commodities as being part of the broader old economy, we look at the old economy, it represents 35% of GDP, but it has 2/3 of the corporate losses. It has 90% of the non-financial debt. And the reason why it has such a large share of the non-financial debt is it produces physical assets. Physical assets can be collateralized, hence so much debt. The third one is they represent 80% of emissions, going back to why this is going to be a big issue at Davos. So the other words I like to say is you look at the old economy, they are overbuilt, over-levered, and over-polluted. Right. And all three of these factors create a sharp decline in the ability to invest. Let's talk about overbuilt. Poor returns, capital gets redirected. Over-levered, they have to take most of their cash flow, pay back debt, as opposed to putting it into the ground. And then the third, over-polluted, because they're the target of emissions, capital is being restricted from the sector. As a result, investments declining. Now let's bring it back to oil and the roll yield there. So we started to see a tightening of the market, aided by OPEC cutting back production. That puts upward pressure on the front end of the forward curve. But then, because they don't have access to the debt and equity markets, they sell the back end of the curve and you get a rotation of the curve. That's where you get that 15 to 20% roll yield from owning on oil. So our forecast is $63 a barrel. Market's trading somewhere between 64 and 65. So the price we expect to come down a tiny, tiny bit, but the return's going to come from rolling that front end.
So you do see a ceiling, even though there could be some disruptions in the Middle East. We've seen it already in Libya with the pipeline. We've seen in Iraq a temporary halt this weekend, I believe, at one oil field. You have the uncertainty with Iran as well. So is there a ceiling on the price, you think?
Well, we've witnessed that and with uptick back in September in the oil market, and you saw it with Iran at the beginning of this year. It would have to be a very substantial disruption to push prices above $70 a barrel on a sustainable basis for several reasons. One, the U.S. is still sitting on an enormous amount of inventory, the SPR. In fact, you go back to in the fourth quarter of last year, the U.S. officially became energy independent. So it has all of these strategic reserves that it doesn't need anymore. And then you look at the emerging markets. When we used to go up to $100 a barrel, bringing it back to the issue of income inequality, is that they used to subsidize prices. So the price could go up very substantially, and the people in these countries would not feel it. The problem is today, those subsidies are gone, the price goes up, they feel it, the demand drops off substantially.
All right, let's take a look at what's making headlines across the globe. Sue Keenan of Bloomberg News brings you the First Word headlines.
We start with the latest on the trade front. France and the U.S. have reached a truce on digital tariffs that will mean neither side imposes duties this year. President Emmanuel Macron tweeted that he and his counterpart in Washington have had, quote, a great discussion, and that they will work together to avoid an escalation of tariffs. Now, the accord brings France and the U.S. back from the brink of a full-blown trade war over taxing digital revenue. Hong Kong, meanwhile, has seen its rating as a long-term issuer of debt lowered a notch by Moody's. This just weeks after Fitch took similar action. Now, both blame the long-running social unrest, with Moody's pointing to inertia in government and the absence of any tangible plan to address the concerns of protesters. There is some hope for the future, though, with Moody's raising its Hong Kong outlook to stable from negative. Meanwhile, a new record published at the World Economic Forum, a new report in Davos, says that the proportion of CEOs expecting global growth to slow this year has risen tenfold since 2018. The PwC survey means that more than half of the near 1,600 bosses questioned in 83 different countries predict a slowdown, and that's the most since PwC began asking businesses such questions in 2012. Executives were pessimistic in every region, with confidence at its lowest since 2009. To Iran now, civil aviation authorities there have released a second report into the downing of that Ukrainian passenger plane, saying it was hit by 2 missiles shortly after takeoff. All 76 people on board the Boeing jet died when the plane crashed shortly after takeoff outside Tehran on January 8th. Iran initially blamed technical issues for the disaster, but later admitted the plane had been wrongly identified as a cruise missile and fired upon. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, let's turn attention back to India and, in fact, to the trade setup for the day. Agam Vakil is here to set you up and also to tell you what's happening in the futures and options space. Morning, Agam. Well, we saw a huge spike yesterday and then we saw a precipitous fall.
Yes.
What are we looking at in terms of the start of trade today?
Well, Alex, there may be fear that this fall may lead to more losses, considering the kind of momentum that we saw with the come off in the markets. But for now, the SGX Nifty is very well indicating that too, about 0.5% cut right now. And to take a look at how markets did pan out yesterday, we did see a bout of profit taking yesterday with about 1% drop for the Nifty 50. Mid-cap and small-cap indices also falling, but not to the extent that we saw the weakness in benchmarks, and to a great extent that was to do with, well, a lot of these heavy cap companies coming up with their earnings last Friday. Nifty Bank and Nifty PSU Banking Index also down by around 1.5%. Let's wait and watch about as to whether or not we do see some recovery, but for now the opening doesn't really look that great. Let's move on and talk about your fund flows, and we really didn't have too much to speak for when it comes to FIIs. DIIs, on the other hand, selling stock worth a little over 1,400 crores, and which means that there has been a lot of participation from DIs, that's towards the selling side. Let's also talk about your contributors. Reliance Industries, TCS and HDFC Bank, all of them came out with earnings on Friday and Saturday, and all of them were leading to losses. Quite a bit was on account of Reliance Industries and HDFC Bank. Of course, we did see weakness all around. But how are things stacking up for the futures and options space? Let's pull that up as well and take a look at what's happening here. So we are seeing longs unwinding. We saw the Nifty give up 11,300. At one point, it was about 12,400 as well. And of course, we've seen that decline coming through. And for the Nifty Banking Index, there's fresh shorts building in, considering a 17% increase in open interest. Let's move on and talk about your change in the levels, if there is any. For now, of course, we continue to see a defending of the 12,000 mark. And it does seem like it's a very strong support at this point in time. Let's wait and watch if things change eventually over the course of the next few days. And as one might expect, we also saw a little more writing around the 12,300 mark, considering this, we saw the Nifty come off from those levels. Let's move on and talk about your WIX. And again, unexpected lines rose 9%. As far as the Nifty put call ratio is concerned, that came off and currently at around 1.1. In terms of stocks, let's keep an eye on Power Grid, PFC, Indian Oil. Of course, PFC and Indian Oil saw a sharp cut with a lot of shorts building in. With Power Grid and Federal Bank, on the other hand, looking at gains. It was the oil and gas space which was in focus, as you can see here. And let's move on and talk about those stocks we saw unwinding. We saw NBCC, MRF, and GAIL looking at a little bit of decline in open interest. But Alex said it was a weak day of trade. Weakness was across, and there's a high chance, as the SGX Nifty is indicating, that we may very well start on a negative note.
Thanks so much for that, Agam. All right, let's take a closer look at some other stocks. In fact, the stocks in news. Somit Sarkar is joining me to tell you all about those. Good morning, Somit. What's on your list today?
Good morning, Alex. I'll start off with the earnings that came in post-market. Firstly, ICICI Securities, where the revenues were up nearly 4% compared to last year, while the net profit saw a jump of nearly 35.6% compared to last year. And the higher profit was account of a reduction in expenses, lower tax rate. And if you see segment-wise, the retail segment did revenues of higher by 5%, while the distribution business revenue were down nearly 4%. The company added nearly 94,000 new clients in the third quarter of financial year 2020, and the two positives from this quarter was market share gain in the broking business and cost optimization initiatives of the company. KEI Industries was the second result. The results were largely in line with the estimates. Revenues were up nearly 21%. Net profit jumped nearly 49%, while EBITDA was higher by nearly 18.4%. Segment-wise, cable and wire segment revenues were up 25%. EPC project revenue were up 54%, and the domestic institutional sales were up 24%, while the export institutional sales were up 83% compared to last year. However, the company's gross margin contracted due to a rise in copper prices. And management commentary, the management is expecting to achieve nearly 18 to 19% growth in FY20. Now, so far in the 9 months of FY20, the company has already achieved a 22% growth, which means that there could be some growth moderation in the fourth quarter of financial year 2020. Just as the third result, the revenues were up nearly 4%, net profit was higher by 8%, EBITDA increased by 21.6%. Now, margins came in higher at 28.5% due to lower other expenses, lower employee costs, and lower ad costs. Realizations, however, were down nearly 6% due to a macro slowdown. In other stocks to watch, firstly, NBCC. Now, the company has received a letter of acceptance from Central Coalfield for a Jharkhand project, a management service contract worth nearly 720 crore rupees. Along with this, HG Infra, because they have received the appointment date, that is the start date to start the project from NHAI for one of its HAM project in Haryana. The company had the bid cost for the project stood at close to 580 crore rupees. Balrampur Chini explosion, according to the company, explosion occurred at its distillery unit. Now, according to the company, it may take nearly 7 to 10 days to get the capacity up fully, and the accident would not cause any production loss to the company on an annual basis. That is what the company said in a release to the exchanges.
Thanks so much for that, Somit. On to Davos now, where the International Monetary Fund has cut India's 2019 growth forecast to 4.8%, citing stress in the banking and NBFC sectors. It has also trimmed the 2020 growth forecast to 5.8%. Menaka Doshi spoke to IMF chief economist Gita Gopinath on the rationale behind the cut in India's growth forecast. Listen in.
Broadly speaking for the world, as well as, of course, applicable to India, you said emphasizing a balance between monetary and fiscal policy, that national level policies should provide timely demand support. Now, we're on the annual of the budget in India, which, as you know, is a big thing, and we're hoping that that will provide some sort of fiscal expansionary support to the economy. What do you think is the best course of action the government could take?
Well, let me just be clear, for instance, on our fiscal advice, it's important for countries to have the fiscal space if you're not a country with very large levels of debt or already very large fiscal deficits. Now, in the case of India, it is important that the fiscal targets are met, at least from a medium-term perspective. And it's also important that if spending is done, it's done on public investment as opposed to consumption spending. Now, there's also other stimulus in the system in India, which is the monetary policy rate cuts that happened in 2019 and the corporate tax cut that happened in the fiscal side. So there is a stimulus. I would say that in terms of the major issue to deal with is the weakness in credit growth. How do you get credit growth back up? But at the same time, making sure that there is not going to be a second round of non-performing assets in the future. I think that's the balance that the government has to hit.
When you speak of investment in infrastructure, let's say, as opposed to consumption, or you speak of longer-term measures, or you speak of the fiscal space, the point is we're at 5%, and we desperately need to do something to get growth back up. Are you suggesting that if the government were to do something on the consumption side, that would not be viewed well by the world?
Again, I don't want to make a blanket statement on this particular issue, but what is important is to address the underlying source of the problems. The underlying source of the problem is stress in the financial system. And some of that has to do with non-performing assets that have been around for a while. So there has to be faster resolution, and I talked about how you might need greater infrastructure there in terms of being able to get timely resolution outcomes. So those kinds of issues have to be dealt with. On the fiscal side, it is also important to make sure that you have sufficient revenue mobilization, including from the goods and services tax. So those aspects have to be dealt with. It's not always the case that if you were to increase spending, you're going to make the deficit worse, because you can shift spending from one area to another, and that can have an impact on growth. So there are many ways to doing this, but I just want to flag that it's important for there to be a medium-term fiscal consolidation target for India.
All right, consumer lending has hit a bottom. There are also signs of an uptick, according to Sanjiv Bajaj of Bajaj Finserv. But will that uptick sustain? Here are some of the key takeaways of the interaction Menaka Doshi had with him at Davos.
Early signs in the last 4 or 5 weeks, we are seeing some uptick on the consumer lending side. Okay. But I think it's still too early to say whether this is sustainable. I'd like to see how the rest of Jan, Feb and March go before we see whether we've... I think we've clearly reached the bottom, but are we making our way up or not? Our growth, while still strong, is slower than what it was last year or the year before that. And it's conscious. We have cut out the bottom 15-20% of our approvals normally because we feel that those people are leveraged at a level where if salaries are not going up, they're not going to, or they may not end up meeting those obligations. And that's a responsibility that as lenders we must have. We can't just keep lending indiscriminately either. I think this government, and I've been saying that for a few quarters, needs to put aside its fiscal discipline for maybe 24 months and jumpstart the economy. If not, it's going to be a more disciplined but a very slow climb back. And we'll see the budget on the 1st of Feb.
Yes.
If the government does provide that boost and the economy grows, that ends up being positive then for the sector. I'm clear we're going through a pain. I'm clear that there's something that the government needs to do to lift this economy up, and there are risks associated with it. There is the risk of fiscal loosening, and then how much you should do it. Naturally, there are experts and economists there. I'm not an economist to say that, but we need that tailwind at this point of time to rebuild the sector. If RBI were to have a liquidity window for NBFCs, and you have to set aside some GSECs equivalent of an SLR for that with the RBI as security. And against that, RBI says that, we are here to provide that last backstop on liquidity. I think it creates tremendous confidence, and you would not see the liquidity problem resulting into solvency that could happen with some of these NBFCs. The RBI does not give NBFCs a standalone credit card license. Now, when I see NBFCs like ourselves for the last 15 years, we probably have the largest experience on the consumer lending side. I don't think there is anybody else who does 100,000 loans a day. We'll do this year almost 30 million loans. We understand the consumer. We have a co-branded credit card that performs very well. So one can see from experience who are the better NBFCs and give them some of these facilities, because if we have to digitize this country, if we have to enable this country and help it grow, then those companies that are doing that, you should support them as well. One thing to do is to just put or create incentives for the average consumer to buy another house, to buy another car. So I would say cut GST on autos. You could cut it for 12-18 months. Yes, it will cause some bleeding, but if the economy picks up, growth picks up, your denominator will also go up.
Correct.
Your deficit as a percentage will come back in a couple of years. So I would say that is something to do. Second is, we have talked of Make in India. We want to bring the world here. We have to be consistent then across what we do when we want to attract the world over here. And why attract the world over here? How about attracting Indian business over here? So I would say that while the move on corporate tax was a good move, but just keep one low rate for everybody.
All right, the large capital influx into Asia has not resulted in higher economic profitability, according to Oliver Tonby of McKinsey and Company. He spoke to Menaka Doshi at Davos and explains why companies in Asia have failed to turn invested capital into economic profitability.
There's been a huge amount of investments globally, but also in Asia. 1 out of every $2 has been invested in Asia over the last 10 years. A significant part has been in China. If you look globally, that's been about 1/3 has gone into China. But that means that there's still a lot of money that of investment that has gone into the rest of Asia. The paradox is that a lot of that has been into value-destroying sectors. Over the past 10 years, we look at a 2-year period, 2005 to 7 versus 2015 to 17. In that time frame, the economic profits have dropped from positive 700+ billion worldwide to a negative 30+ billion worldwide. Half of that drop has happened in Asia. Now, if we stay at the global level first, there are 3 things that have disproportionately led to this drop. Number 1 is energy and materials investments globally, anywhere in the world. Those have, by and large, in most countries, been value destroying. We used to have a super cycle in the 2005 to 7. Now those have been value destroying in that time frame that we looked at. Secondly, is European financial institutions account for another large part of the 700 decline. And thirdly is China in itself is also is a huge part of the downward drive. As I mentioned, 1/3 of all investments happen in China. Almost $10 trillion of investment in China. 80% of that has been in value-destroying sectors. So that gives you a little bit of a picture of the global, what causes the global downdraft, so to speak. Having said that, we see value creation in pockets in all countries. There are some sectors in most countries, and we see some sectors globally that have been very positive. For example, in the IT and the tech space globally, we've seen that has been a value creator globally. We see pockets in Japan, the capital goods sector, which means investments into heavy manufacturing, automotive, chemicals, has been value creating. We see that tech investments into Japan, Korea, China have been value creating. Even if you take energy and materials, which I mentioned was a large reason for the downward drop, in some places like Southeast Asia has actually been a positive value creation contributor. These investments are now sunk. They've been put in place, so we now hope to start seeing the returns on some of these over time. So the picture will change quite a bit. But I would zoom in on 2 things in Asia, particularly. Number 1 is what we call the troubled 200. These are the 200 largest companies that have destroyed more economic profit than others. We somehow need to find a way to turn around these, and we've seen that turning around some of these troubled 200 has been more stubborn in Asia than in the rest of the world. At the other side of the curve are the terrific 200. These are the companies that really have created a disproportionate amount of that value, and many of them are either in tech, in consumer, and pharma, and we expect to see those continue to drive. And that is actually true across many countries. So at a country level, you would hope and want the country to disproportionately invest in some of these sectors going forward. In Asia in particular, we're seeing increasing regionalization. So we've done a lot of research looking at all kinds of flows, not only capital, not only trade, but also in technology and flows of people and so forth. And we're increasingly seeing Asia for Asia in these flows. Just a couple of examples, we see that travelers Now, Asia is responsible for a huge part of the travelers worldwide, and more than 70% of those travelers are actually within Asia. They travel within Asia. Asia is responsible for 48% of international students. A number of them are intra-Asia. Most of the trade is actually happening, almost 70% of the trade is happening within Asia. Capital inflows, capital goods is happening within Asia. So we see Asia for Asia. So that's one of the chapters of the next, of globalization going forward. RCEP and such treaties, I think, will increase that regionalization because some countries have opted out, as you know, but many countries still are in. We are positive to these trade treaties. We believe that they help smooth trade, and that is generally a good thing.
All right, let's turn back to India now. The government has filled top-level vacancies at 3 large public sector banks. That's Bank of Baroda, Canara Bank and Bank of India. Remember, 2 of these have remained vacant for months now. With the new heads, the government hopes to stabilize their operations. Vishwanath Nair of BloombergQuint reports.
The government on Monday announced appointments at 3 large public sector banks at the MD and CEO positions, positions which have been empty for months on end. Specifically with respect to Bank of Baroda, where PS Jayakumar had retired in October last year. There, the government is appointing Sanjiv Bajaj, who's a Deputy Managing Director at State Bank of India and also currently leads the SBI Capital Markets. Now, he will take over the position of MD and CEO at Bank of Baroda immediately and will hold that position for a period of 3 years. With respect to Bank of India, Atanu Kumar Das, who's currently an executive director in the bank, he has been elevated to the MD and CEO position and will hold that position for a period of 3 years as well. Similarly, LV Prabhakar, who's an executive director at Punjab National Bank now, will take over the position of MD and CEO at Canara Bank. Remember that the current leader at Canara Bank, who's R.A. Shankar Narayanan, will be retiring on the 31st of January. So after that, LV Prabhakar will be taking over the position as MD and CEO of Canara Bank and will hold that position till the 31st of December 2022, which is when he will superannuate. Separately, the government has also said that C.S. Sethi, who's currently a Deputy Managing Director at State Bank of India, he has been promoted to the Managing Director level. Remember that Managing Director level has been, that position has been empty since Anshula Kant, who was the MD and CFO at State Bank of India, left last year to join the World Bank. So that position is now being filled by C.S. Sethi.
All right, that's all you need to know going into trade today, but do stay tuned. There's lots to talk about on the earnings front as well as everything else in the markets. You'll find all of that here on BloombergQuint.